Section 0.2, Economics of Energy Trading and Price Discovery. Part 2 of this handbook is devoted to the economics of energy trading and price discovery. Energy markets, their organization and price discovery processes necessarily reflect technical features, elasticity of demand and supply, ease of transportation, transmission, potential for storage and intertemporal arbitrage, potential for substitution of one form of energy with another. On this basis, organizational and contractual structures are put in place which then shape the process of price discovery and eventually determine market prices. Oil is by far the most widely internationally traded commodity in the world. Notwithstanding the decline in its price over the second half of the 2010s, crude oil alone still accounted for a significant share of international trade, and its weight has further increased with higher prices since 2021. The price of crude oil is a frequently referred to indicator for gauging global economic conditions. But the organization of the global oil market is very peculiar, as quality differences have significant bearing on the price of individual crudes, and trading takes place on the basis of reference to a limited number of physical benchmarks, whose availability and quality also evolve over time. Chapter 18. In addition, the logistics of trade delivery, whether seaborne by ship or overland by pipeline, also deeply influences the functioning of physical crude oil trading. The time dimension, which reflects delays needed to organize shipping or transit times, creates a demand for hedging instruments, which, in turn, motivates the establishment of a futures, or paper barrels, market that has grown enormously and has become the primary price discovery ground, with multiple ancillary markets linking different contracts and leading to advanced financialization. All of which means that the price of oil is not as straightforward as the price of potatoes in your local market. The complex structure and interrelationships must be understood to validly interpret the daily gyrations in the price of oil. Oil product prices are discussed in Chapter 19. These obviously not only reflect the underlying price of crude oil, but also respond to the peculiarities of production and use of each product, keeping in mind that all are joint products from a refinery, whose configuration may differ significantly, as explained in Chapter 3, but cannot change in the short run, creating imbalances in the equilibrium of demand and supply of individual products at any moment in time. This chapter explains which hydrocarbons are mixed up inside a barrel of crude oil and how the refining process separates, treats and upgrades the composite to extract the usable products needed. It looks at whole crude properties and what these mean for handling and transporting the oil. It defines the different types of refinery process, from primary distillation to reforming right through to cracking and coking. It describes the range of products that result from refining crude oil and the use to which each product is put. The pricing of internationally traded natural gas, discussed in Chapter 20, has fundamentally evolved over time, moving from predominant indexation to crude oil or oil products in accordance with various bespoke formulae peculiar to each long-term contract, to growing reliance on gas-to-gas competition and the emergence of gas trading hubs where both physical molecules and financial products are traded. The chapter explains why gas suppliers traditionally defended long-term oil-indexed contracts and analyzes the main features of historical contracts. The old consensus on oil indexation, which had been a pillar of international gas trade for a decade, has been eroded in several regions. Beyond Europe and North America, Asia is also gradually moving towards a larger share of hub indexation, although it is still lagging behind in the process of establishing its own hubs. The chapter concludes that gas prices remain regional even if additional convergence is materializing thanks to the globalizing effect of flexible LNG. The chapter devoted to international coal trading, Chapter 21, offers a view of coal production, consumption and trade at both global and regional levels. Given China's dominance of coal markets, the chapter describes the geography of Chinese coal supply chain in some detail. Some concepts of geology and mining are explained to facilitate a better understanding of the different coal qualities and grades, which play a more important role in coal trading and pricing than for other fossil fuels. The chapter offers a historical perspective of the evolution of the international coal market to describe the current market, very dynamic and liquid, with increasing variety of qualities. The trading of electricity, Chapter 22, is conditioned by the need to constantly balance the grid, meaning that wholesale prices change almost continuously to reflect the changing balance of demand and supply. Therefore, in competitive markets electricity is traded in intervals that tend to be shorter and shorter, e.g. a new auction is conducted every 15 minutes, but in some markets every 5 minutes, as well as on a day-ahead basis. After a description of the functioning of wholesale electricity markets with a focus on the derivatives and the spot market, the authors analyze not only their main features such as trading venues, traded products, rules and the processes, but also some key trends that can be observed. Going forward, electricity systems around the world are undergoing nascent but profound changes as market architecture and regulatory framework evolve to meet ambitious climate targets while maintaining efficient investment incentives and security of supply. With the growing concern for climate change and based on the conviction that this is due to a market failure linked to the negative externality of emitting greenhouse gases, which the emitter is normally not requested to pay for, policies have been introduced to correct this and impose a monetary charge on emitters. This can be achieved either through the imposition of a carbon tax, i.e. a fixed price for each ton of CO2 emitted or equivalent, or through the creation of a market for emission allowances. Chapter 23 explores the concept of carbon pricing, with a specific focus on the trading of carbon via emissions trading systems, ETSs. The analysis starts with an overview of the main design options for a cap-and-trade system, presenting the experience of the European Union, EU, ETS as a real-world example of how such systems work. The history of the EU ETS is thoroughly examined, explaining what the main challenges and benefits of the system are and what lessons can be learnt from the world's biggest ETS using the European experience as a benchmark. Other major ETS markets are also analyzed, highlighting the potential for interconnection of different systems as well as the prospects for international cooperation mechanisms under Article 6 of the Paris Agreement. The last chapter in Part 2, Chapter 24, is devoted to the process of unbundling of vertically integrated industrial structures for the sake of enhancing competitive market relationships in lieu of market dominance on the part of one or few players. Energy market restructuring and liberalization have produced mixed results. While wholesale market design and competition have matured, retail competition has remained static. This chapter discusses the reasons that contribute to the success and failure of energy market unbundling with the use of global examples. The new trends and policies in energy markets are discussed from a regulatory perspective, including active investor participation, technological innovation and the growth in renewable energy.